Welcome to the podcast from Morningstar UK, the leading provider of independent investment research. It's our final podcast of 2016, so what better way to finish the year off than to share our most popular content on morningstar.co.uk, the top 10 of 2016. To get us started, at number 10, we have Old Mutual UK Alpha Fund Manager Richard Buxton giving us his 3 stock tips.
Hello, Richard.
Morning.
So what's the first stock today?
HSBC. This is a very sort of stodgy, boring, large cap stock, but firstly, it's a dollar stock, and with sterling weakening, you're getting automatic upgrades to profit forecasts from HSBC. Secondly, it's financial, and as we begin to see that perhaps the bond bull market has come to an end after 30 years, gilt yields are just slightly starting to move upwards. A positive move upwards in interest rates, particularly in the US, will be hugely beneficial to the profitability of someone like HSBC.
Now, HSBC is a financial, and it is a UK domiciled financial. There's a lot of uncertainty around financials, as you well know yourself, post-Brexit. How much do you have to take that into consideration when choosing to invest in HSBC?
Very much, but I think the shares until very recently, because of the currency movement, financials have been very unloved. They are under-owned, and I think they're pretty cheap. We met the finance director recently. We're extremely confident that the very attractive dividend yield is going to be maintained. There's a number of analysts who still suspect it will be cut. So you've got a very reassuring degree of support from the yield coming through from the stock, and because they are very exposed clearly to faster growing markets like Asia, I think you can take a lot of comfort from owning that stock.
And what's the second stock today?
Tesco. Now, 5 years ago I sold Tesco, 5-6 years ago, after many years of ownership. We know there was a sort of slow motion car crash for a number of years, but I bought back into it last year. I think that Dave Lewis, the new chief executive, ex-Unilever, has acknowledged it's going to be a 5-year process turning this business around, but recent results have clearly shown that it's beginning to work. All the actions that he's taking, they're beginning to attract customers back, and they're spending a bit more money, and they are still far away the largest player in what is a very crowded UK market. So although we fully accept it's still an incredibly competitive industry and the discounters are here and they're not going away, I do think that slowly, incrementally, he will be able to turn that business around, and that will be rewarding for shareholders.
Now, Tesco was a dividend darling. However, it's cut its dividend following the expenses scandal. Not expenses, accounting rather. Yeah. Do you see Tesco being in a position to reinstate that dividend anytime soon? Not
anytime soon. If they did do something, it would be remarkably token, because they still have quite a lot of debt on the balance sheet. And they'd rather, be honest, spend the money buying in some of the leases on stores that they sold in previous years, buy them back and own them, and avoid some of the very onerous rental increases and so on. So no dividend from them anytime soon, but if you've got your HSBC, you'll have a nice yield there. But I think it's still a good 2-3 years to go before they can really get back to a level of profitability where you will start to see a resumption of dividends.
And what's the third and final stock?
Merlin Entertainments. Now, this is a worldwide business, but listed in London, that owns theme parks and attractions, which is a fabulous long-term structural growth industry. They partner with Legoland to build all the Legoland parks around the world. It's not a cheap share, because the market does recognise the quality of the long-term franchise, but they've suffered a little bit this year, because, bizarre to recall now, but the pound was actually stronger against the euro, so they suffered from more Britons holidaying abroad, fewer visitors to the UK, and London is quite an important centre for them. But clearly next year the reverse will apply. There may well be many Brits who end up concluding they'll holiday in the UK, so go to the UK attractions, and conversely there'll be many more visitors coming to London from overseas. So that's a kind of short-term fillip for the next 12 months to what is a very good long-term story.
And how concentrated in the UK is it? Because, of course, there is still a slight threat of recession post-Brexit. And with stocks that are too domestically focused, that is something to be concerned about, isn't it?
It is. I think the UK economy will gradually decelerate, and it is going to be quite sluggish. But as I say, with a company like Merlin, it is it's so driven by overseas visitors to London in particular, that whilst its other attractions in the UK are important, it's far more offset by people coming to the London Eye and so on and so forth. So I think they're pretty well hedged against consumer weakness in the UK.
Richard, thank you very much.
Not at all.
At number 9, Chris Rice from Sanditon Asset Management, who we interviewed back in May this year at our Morningstar Investment Conference in London, warns viewers to hold cash and prepare for a market crash as he believes recession looms.
Hello, Chris.
Hello.
So you seem to be the bearer of bad news for investors. How bad is it?
Well, in some respects, actually, the corporate cycle is fairly normal. We've had effectively the third longest bull market in American history. So you would think things were actually quite fine. And actually, corporate profits in America are at their previous peak. So in pure cycle terms, everything's fairly normal. What's different this time around in this particular cycle has been the extraordinary intervention in financial asset markets by our central banks. So if you look at the whole swathe of financial assets, cash is currently yielding a negative return because inflation is higher than the deposit rates you can get. 85% of bond markets yield less than the US 10-year, which yields 1.7. The median price earnings ratio in Europe is 20 times earnings. It's the same in the United States. And property is virtually only affordable for those with enough money to transfer to their children. So the vast majority of financial assets are incredibly low yielding because of the intervention by our central banks. And after 7 years of that process, we should have been withdrawing it. My bearishness comes more from the fact that asset prices are high in relation to what has been a fairly normal business cycle.
Of course, what's happened is this intervention has meant that investing 101 has broken down. Diversification is not possible. Normally, equities, or the rule book says, equities do well, bonds do badly. Bonds do well, equities do badly. But what you've just told us is there's literally nowhere to run, or so it seems, because everywhere is looking toppy.
Well, there's an element of truth in that. And when you get to the end of these sort of very long cycles where yields get incredibly low, the financial history books tell us that in real terms we start to lose money. Now, the major sort of example from history we have to look back to is the 1970s. Now, of course, in that period, they managed to engineer inflation, which is one way of solving for the fact that a numerator and a denominator are too far away from each other. So there are many outcomes that I don't know of, and I suspect a lot of other fund managers and investors don't quite know how it's going to play out. What we can observe is there's just really poor value. And on your point of correlation, it's a really important one, because the one correlation that actually has worked up until recently has been equity bonds. Within equities, it's been very hard to get anti-correlation. Within bonds, it's been quite hard to get that diversification benefit. But reliably, we've had this situation where typically you've had a pullback in equities, bond yields have fallen, and therefore you've been able to counterbalance the two. Since the end of US QE, that's started to break down. You've found typically sometimes both can go down at the same time. So that's why I said in my presentation, I think that in the first line of defence, as we go from a slowdown into a recession, I think the first line of defence has to be cash. We do run a long-short portfolio, and we have said to our clients for some years now that the likely way of defending yourself in a long-short portfolio, if you can, is to go net short the market. And that would be another way of seeking protection.
So it's not all doom and gloom. There are ways for investors to, at the very least, get capital preservation in these uncertain times ahead.
Yes, I think that's right, absolutely.
Chris, thank you very much.
You're welcome, thank you.
It's not surprising that one of the topics that have most concerned investors this year is Donald Trump's victory in the US presidential election. Coming in at number 8, senior editor for Morningstar.co.uk Emma Wall and Dan Kemp, Chief Investment Officer for Morningstar Investment Management, brought us the breaking news on the election result and what it means for investors.
Hi, Dan.
Good morning, Emma.
So it looks today as if Trump will be the next president of the United States. How have markets across the globe reacted to this news?
Well, the first thing to say, of course, it's still very early days, and so we are living through these initial reactions. But I think it's fair to say that the initial reaction was not good. It was most pronounced in Asia, because, of course, those were the markets that were open at the time, and we saw some very steep falls in asset prices there. And that's sort of started to creep through into Europe, but it's now a much more nuanced, mixed reaction. We can expect to see that with the news flow of the next days, weeks and months. But of course the important thing from an investment perspective is to look through that and focus on the long term.
So what can investors outside of the US do with this news then?
Well, the first thing is to avoid making the classic mistakes of investors, and that's either to be pulled along by the herd and as prices are falling decide to sell, or secondly to try and capture a bounce in markets. Both of these strategies are essentially gambling. We have no idea what markets are going to do in the short term. Certainly people didn't expect this sort of reaction when they went to bed last night and US equity markets had actually risen yesterday. So we can't anticipate what's going to happen over the next few days. What we can do is look at genuine value opportunities, some of which have become cheaper and will become cheaper over the next days, weeks and months, and use that opportunity to add to these long-term positions.
And it is a very important point to make that we are in early days, because although Trump has declared, Hillary has not conceded to that. And even if we are going to have a Trump president, we're not going to have a Trump president until January. So the markets have all that time, plus any policies he puts in after that, to react to all of this noise.
Exactly. And so investors are going to have plenty of opportunities to buy cheap assets. And even if you're looking at assets today and they look cheaper than they were yesterday, then just remember they can get much cheaper. Markets can be pushed to extremes, and so you might want to add to positions you like today, but leave some powder dry to keep adding in the future as news drives markets into unforeseen places.
And it also is worth remembering that if you don't have high conviction over any asset class at the moment, because let's be honest, we're in a slow growth, low growth world, it's okay to just do nothing, isn't it?
Absolutely. That should always be the default position. You should like the positions you had today as much as you liked them yesterday. And so there's no need to react. That's always the first temptation for investors, that they think it's better to do something rather than nothing. Very often it's better to do nothing and just keep doing the research, keep looking at great sources of news and data and work out where genuine opportunities are occurring.
Dan, thank you very much.
You're welcome.
Back in April, we interviewed Alex Wright, manager of the Fidelity Special Situations Fund, who gave us his 3 undervalued stock picks, including Lloyds Bank. His interview comes in at number 7.
Hi, Alex.
Hi.
So what's the first stock you'd like to highlight today?
The first stock that I think really interesting today is Lloyds Bank. It's been a long-standing position for me. It's about 5% of the fund, so within the top 5. It's still a very cheap share, despite what is a big improvement in performance over the last couple of years. So earnings have really recovered here post the financial crisis, really strengthened the balance sheet, and the company's now trading on only about 9 times forward earnings, which compares to the market as a whole on about 15. So a big discount despite that recovery, also yielding on our analysis probably about 8% in special and ordinary dividends this year. So I think very attractive from a dividend point of view as well.
I know obviously your fund has the word special situations in the title, and there's a number of different ways that you can choose to interpret that. Which sort of silo does Lloyds would fall into within that idea?
Well, for me, special situations is all about stocks where significant change is happening, and often that change is due to a recovery from a poor current circumstance. So Lloyds clearly had a very difficult financial crisis after taking over HBOS, which had an awful lot of problems and really needed to both rebuild its capital position and also improve its earnings after some significant losses. So Lloyds is one of the more advanced stocks through that journey in the fund, having got rid of a lot of those problems, really restructured the business, and now in much better health today.
But still a little further to go.
Yeah, I think it's still undervalued given the journey that it's gone through. So I would have expected the stock by now to actually be at a much higher valuation, given they really have demonstrated that improvement in earnings and improvement in the balance sheet that you've seen over the last 5 years.
And what's the second stock today?
So the second one I want to talk about is CRH, another large company and another big position for the fund. Something a bit more recent purchase and less of the way through its recovery journey. So still looking quite expensive today on near-term earnings, about 15 times. But actually, when you look at margins, they're half the level they were back in 2007. So there's an awful lot of room for improvement over time, and indeed our internal analysis at Fidelity suggests they can almost double margins over the next 3 years as they see an improvement both from their underlying markets in the US and Europe, as well as some large synergy benefits coming through from the recent transaction they've done buying a lot of assets from the combined Lafarge Holcim company.
And that's a construction company. How aided has that been by sort of government support? Does it build houses? So those home builders have obviously been propped up by certain initiatives from this government. Where does this fit into that?
So this is much more for commercial and infrastructure investment. So there is a bit of house building, but that's pretty small. And its key market is the US, and then its second market is pan-European. And actually those markets are still quite depressed. So while housing has been recovering, and to a degree commercial construction in the US, that's yet to happen in Europe. And then particularly infrastructure is only really started to turn around in the last 12 months or so. And I think that's the next big kicker to the story in terms of its recovery.
And what's the third and final stock?
So the third stock I want to talk about is Bloomsbury. It's a much smaller business and a much more recent purchase, and only for my smaller fund special values, one of about 20 stocks which are too small for special situations. I think this is interesting because it's a stock primarily known as the publisher of the Harry Potter novels. That's actually down to only about 5% of the business today, and they've been quietly sort of using the cash flow from that and the rest of their publications business to build up an academic publishing business. I think that's a much higher quality business, much more recurring and steadier, but yet the valuation of the stock hasn't yet moved. So only about 11 times earnings, yielding about 4% compared to peers on more like 15 to 18 times. So I think a good story in terms of a business model change there, moving to a more steady and higher rated area.
I mean, it sounds remarkably like what Pearson is trying to do, but let's be honest, Pearson has not been a great story in terms of share price over the last 18 months. What makes you think that Bloomsbury can pull it off?
So Pearson's primarily exposed to the US textbook market, whereas Bloomsbury is primarily a UK academic research. So it's much more like a read business model where they've obviously done very well, and you don't see sort of that pressure in terms of sort of the very high price of textbooks feeding into the business. So I think that's why it's a better story. What's interesting though is Pearson is still rated at about 15 times despite all those earnings pressures. So that's why I think Bloomsbury is very interesting today.
Alex, thank you very much.
Thank you.
Brexit has been another key theme for investors in 2016, and it comes in here in 6th place. Dan Kemp brought us his interpretation of the news, saying investors need to keep cool heads amid the political and financial uncertainty.
As Brexit becomes a reality, savers and investors are faced with two very important questions. The first is, what does it really mean? And second, how should they respond? Now, the first question is much more difficult than the second. The range of potential outcomes during this period of uncertainty is incredibly broad, and investors shouldn't underestimate the type of things that can happen as we go through this bumpy period, certainly over the next 6 months and possibly over the next couple of years. The dangers in this situation is that you make decisions too early and with too much confidence. We really don't know what's going to happen on the political and economic landscape over the next few months. But when it comes to how we should respond, the path is much clearer. Investors shouldn't react too quickly, but instead should do their research to really uncover the opportunities that this period creates. Leave shorting and short-term market movements to the traders and the experts. This is about long-term investment, not short-term reaction.
Coming in at number 5, it's another 3 stock picks interview, this time with gold-rated investor Job Curtis, who gave us 3 income stocks for sustainable dividends back in June.
Hello, Job.
Hello.
So what's the first company you'd like to highlight?
My first company is Hammerson, which is a real estate investment trust.
And why do you like Hammerson?
Well, I like Hammerson because it's on a discount to its net asset value of almost 20% at the moment. It invests purely in retail property. It's 25% in France, the other 75% is in the UK. I think there's an opportunity ahead of the June 23rd referendum when there's a lot of uncertainty on property stocks at the moment, and as a result the share prices have moved sideways, been slightly weak, and yet I think the quality of Hammerson's assets, which are not just shopping destinations but also entertainment destinations for eating out and leisure activities generally, I think those quality of assets means that they will be in use come what may after June 23rd, whatever the outcome of the referendum is.
Now, commercial property, the index itself has done very well over the last couple of years, but that tends to be concentrated in the southeast, that index. Well, you mentioned there that you're looking, there's some global diversification looking in France. Does that help you sort of diversify your revenue streams and indeed keep that growth going?
Well, Hammerson's only one stock within our portfolio, so it's really a pure play on retail property, but it has, as you say, got 25% in France, which is a help, and it's got good quality assets in France. But I think I'm looking at really as a pure play of retail property. I think there's concern that the internet is taking money away from the high street, which undoubtedly it has. But I think if you've got high quality retail assets, these are kind of destinations that people go to entertain themselves, to eat out, go to cinema as well as shops. So I think they will hold up despite the growth in the internet.
And what's the second stock today?
My second stock is Pendragon, which is a motor retailer, again slightly hit in the uncertainty ahead of the referendum. But I think, car sales have been strong in recent years, but I think they're set to continue to be strong given low interest rates and the way that people can finance purchase of both new and used cars. And Pendragon is our largest car retailer in the UK. It's well managed. It's on a very cheap valuation. The price-earnings ratio is around 10 times, and its dividend yield is approaching 4%. So I think it offers very good value at these levels.
Now, as you alluded to there, autos is one of the sectors where people are slightly nervous as there is a Brexit, because at the moment there are no tariffs, are there, between the UK and the rest of Europe with auto trades, but they could go up to sort of 20%. You think this is not a concern, however?
I think it's unlikely that tariffs in traded goods would occur, particularly because Europe has a big surplus in terms of car sales, and we buy many more Mercedes, etc. Obviously, we do, though, sell quite a few cars into the continent, often though from German manufacturers and Japanese manufacturers like BMW that owns Mini. But I think the real concern is that the pound could fall quite significantly if we leave Brexit, and that would make imports more expensive. But I think sometimes, these factors get reflected in valuations, and certainly the Pendragon share looks very cheap at the moment in my eyes. And if we do stay in, of course, then those scenario doesn't occur, and the betting odds at the moment do suggest 2-1 that we will stay in.
And you get a nice share price bounce.
You should do on that basis. It begin to get anticipated in the run up to the vote, but you should do, in my opinion.
And what's the third and final stock?
The third and final one is an old favourite of mine, which I've talked about in the past, but Taylor Wimpey, I think, still looks attractive. It had a very stunning performance in 2015. It produced a return of approaching 70%. It's moved sideways a bit this year, but it's very strongly positioned. It's got a 5-year land bank. There's a lot of demand for housing across the country. Generation Rent wants to own. And with low interest rates, it's affordable. And Taylor Wimpey's average house price is £265,000, so it's not affected by the problems there may be at the top end of the London housing market. So it's certainly attractive from a dividend point of view. They've outlined a dividend policy stretching many years, and they've actually upgraded the amount of money they're intending to give back to shareholders. So it's yielding slightly over 5% at the moment.
Job, thank you very much.
Pleasure.
At number 4, it's Brexit again. This time, senior editor Emma Wall describes how Britain's vote to leave the European Union seems to tie in with a feeling across the Western world, a rebellion against globalisation and those in power.
3 weeks ago, Britain voted to leave the European Union. This week, 1,000 lawyers have written to the Prime Minister saying that they don't think that vote was legally binding. They have said it was based on a misinterpretation of facts and promises that never had any intention of being kept. However you voted, one thing has become clear since the vote was announced, and that is for the vast majority of people, it was a very emotional decision rather than based on any particular business acumen or understanding of the economic impact. This movement against globalisation, rebelling against the powers that be, is one that can be found across the Western world. We only need to look at the rise in popularity of Donald Trump in the US and indeed Marine Le Pen in France. And what has triggered this movement? Well, perhaps this graph can go some way to explain. This shows how the global community, that is everybody in the world, has had their wealth increase or decrease over the last 20 years. Thanks to globalisation, the very poorest in the world have seen their wealth increase nearly 60% over the last 20 years. Indeed, if we have a look at the very richest in the world, they too have seen their personal wealth massively increase to around 60%. However, if we look at the 20th percentile, that is those people who score about 80 of 100% of the entire world on the wealth scale, they have actually seen their personal wealth decrease. And who are these people? Well, these people are the lower and lower to middle income households in the Western world. Multi-asset investor Tony Nangle from Columbia Threadneedle has drawn an elephant over this chart because he describes it as the elephant in the room and suggests that this could be the catalyst for the reason why people voted for us to leave the EU, and indeed why Donald Trump could be the next US president.
At number 3, Paul Swinand, equity analyst for Morningstar, talks us through how a variety of headwinds that hit the global luxury sector have started to ease off, and that some luxury goods companies are starting to look attractive again.
Right now we're seeing a lot of worry in the global luxury sector. There are global macro issues, protests in Hong Kong, the crisis in Russia, Middle East tourism has been affected by the Syrian situation. So there are a lot of worries in global luxury right now. We think actually that for once the sector is starting to look more attractive because the valuations have come in. Among the group, our favorite pick is actually Swatch Group. Although there are some near-term negatives, we think that in the long run, Swatch should outperform other groups such as Richemont. Also, another interesting group, which is more liquid for global or U.S. investors, is LVMH. It's almost never traded at a discount to our fair value. It is a little more diversified, so they have wines and spirits, fashion, leather goods. So they're much less susceptible to any one sector having a downturn. So again, we think for once, global luxury is more attractive despite some of the headwinds that we're seeing in the market right now.
The popularity of ETFs and tracker funds is soaring in the UK, and our second most popular interview this year was that of passive fund analyst Kenneth Lamont, explaining the key differences between an ETF and a tracker fund.
Well, investors traditionally invest in passive funds for their low cost and for the transparency associated with these funds. The two major options that investors in the UK have are traditional mutual fund, index funds, and exchange-traded funds. The primary difference between these two products is that mutual funds are priced once a day and have a traditional, as I say, mutual fund structure, whereas ETFs are priced throughout the day and traded like a stock on exchanges. The second major difference between the two is that ETFs, certainly in Europe, have a far larger breadth of exposure that they offer. For example, you may be able to buy an ETF which gives you sole access to one country like Vietnam, whereas this exposure is not available with index funds. Also, ETFs are more versatile in the sense that there's a far higher percentage of these funds which are synthetically replicated as opposed to physically replicated.
So, now to reveal the top spot. What Morningstar.co.uk content will be crowned the most popular of 2016? Well, the winner is What is a Fund? Part of our Back to Basics series designed to help new investors understand the investing world.
What is a fund? A fund is an investment vehicle that allows a large number of people to pool their money together in order to invest in a range of different securities, such as stocks, bonds, property or commodities. Funds have differing objectives, such as to deliver a regular income or capital growth for the investor. funds are grouped together into categories determined by this aim and by where in the world the underlying stocks or bonds are from. A fund can be actively managed, where an appointed individual picks which securities to invest in from a larger pool, assisted by a research team. Or a fund can be passively managed, where the investor can gain exposure to a particular index or commodity, providing that investor with the same returns as the underlying market. Funds are suitable for investors who do not have the time or expertise to construct and monitor a portfolio themselves. Funds require a smaller investment than picking individual stocks or bonds, allowing the investor to gain a far greater number and variety of securities.
And that's it for Morningstar Podcast for 2016. It has been our pleasure to provide you all with news, views and education on personal investing this year. From everyone here at Morningstar UK, have a Merry Christmas and a very Happy New Year. We look forward to seeing you in 2017.